When a market in a free fall suddenly reverses into a violent spike, we are seeing a massive shift in order flow. These pivot points don't happen at random. They originate at specific price levels called demand and supply zones, territories where high-volume institutional orders are concentrated. To find a demand zone using the higher timeframe method, locate a massive upward rally and isolate the final red candle before the move started. This represents the last attempt by sellers to push the price down before they were overwhelmed by buyers. Supply zones are found using the inverse rule. Identify a significant market drop and mark the last green candle at the peak. This marks the area where sell orders began to outweigh the buying pressure. This color reversal method provides a quick baseline for finding zones, but charts rarely move in simple lines. To trade these levels effectively, we have to look closer at the market's structural anatomy. Chart mastery requires identifying three-part structural patterns. For supply, we look for a rally followed by a base and a drop. For demand, we look for a drop, then a base, and finally a rally. Let's focus on the base. This cluster of small candlesticks represents an accumulation phase where buyers and sellers are in a state of equilibrium. Price is temporarily stuck in a tight range as large orders are built up. This accumulation resolves when a high-momentum breakout candle appears. If that candle bursts upward, the battle is over. We now have visual evidence that the buyers won the exchange. The base provides a map of where that institutional money is parked. Because these orders are rarely filled all at once, these are the levels that large players are likely to defend. To enter a trade at these levels, you need to define the exact boundaries of the zone. We use the physical structure of the candles in the base to set these limits. First, find the lowest wick in the base and draw a line across its tip. This is your absolute boundary. If the market trades past this point, the zone is no longer holding, making it the objective spot for a stop loss. Next, mark the highest point of the candle bodies within that same base. This second line establishes your entry area, creating a clear zone for your orders. The quality of these zones depends on the strength of the breakout that followed them. A minor 2% move suggests a normal zone, while a sharp 6% spike or a sustained multi-day rally indicates a very strong zone with high institutional interest. Combining these precise wick-to-body markings with a focus on high-strength breakouts provides a consistent framework for evaluating risk and potential reward. Practice this on the chart on your screen. Pause the video and see if you can identify the drop-base rally pattern and visualize exactly where the boundary line should go on the base. Here is the result. The lower boundary sits at the lowest wick, and the upper boundary aligns with the highest candle body in the cluster. Training your eyes to recognize these patterns instantly is the first step toward conducting objective market analysis in real time. Execution begins when the price eventually returns to a previously identified higher timeframe zone. We are looking for a retest of the level where the original breakout occurred. Avoid buying immediately upon the first touch. Instead, look for a confirmation signal, like a price rejection or a reversal pattern on a lower timeframe. This ensures the zone is still being defended by active buyers. Using these higher timeframe zones as a filter helps you ignore minor fluctuations and focus on the price levels where large-scale trends are likely to resume. Success in this strategy comes from identifying the footprints left by major institutional players and waiting for them to show their hand. Here are the 4 rules to remember. Mark the opposing candle before a rally or drop. Look for clear DBR and RBD structures. Draw your boundaries from wick to body, and always prioritize zones on the higher time frame. Screenshot this cheat sheet and start looking for these footprints on your own charts. Subscribe to the channel to learn the next phase of institutional market analysis.